stop scrolling and look at me. Look at the alert on the screen behind me. This isn't a drill, and this isn't a maybe. The ratio just broke 60. For 10 years, we have talked about this moment like it was a ghost story, something that would take decades to play out. It took 60 minutes. While the world was sleeping, the heartbeat of the entire monetary system just skipped a beat. 50 billion in institutional capital is currently screaming toward a door the size of a needle SI. If you aren't positioned by the time the opening bell rings on Monday, you aren't an investor anymore. You are the exit liquidity for the giants. Ladies and gentlemen, Asian guy here. I'm coming to you live because the trigger has officially turned red. In the image behind me, you see the chaos starting to unfold. You see the runners, you see the panic, but what you need to see is the math. The gold to silver ratio, the ultimate barometer of global trust, just slipped below 60. This is not just a number on a chart. It is a mechanical mandate. I need you to understand how the big boys play. Trillion-dollar pension funds don't buy silver because they feel like it. They buy because their risk management software forces them to. Right now, a ghost wave is forming. It's a $50 billion wall of capital hitting a COMEX vault that is, for all intents and purposes, bone dry. We are entering a danger zone next week because the bullion banks have a fatal problem. They have sold paper for years to keep the price suppressed, but you can't pay a pensioner with a piece of paper. They want the physical. They want the bars, and there are no bars left. If you turn on the news tonight, they'll be talking about interest rates or retail sales. They won't mention that the silver market just decoupled from reality. This silence is your only remaining edge. For the last 3 years, the ratio sat at 80-1. The market treated silver like a joke, a forgotten industrial byproduct. But at a sub-60 ratio, the algorithms see a screaming arbitrage opportunity. They see gold at $4,130, and they realize silver is the most mispriced asset in human history. This isn't retail FOMO. This is a great rotation. We are talking about a $50 billion wave of capital program to enter this market regardless of the price. They are price inelastic. They have a mandate to fill. And next week, that wave hits the shore. I titled this Danger Next Week for a reason. When an unstoppable force, the pension funds, meets an immovable object, the naked shorts at the bullion banks, the market doesn't just move. It breaks. We are walking into a minefield. Next week, the adults return to the room, and they have to make a choice. Do they chase this to $100, or do they try to smash the market to save themselves? Either way, the volatility will be violent. I'm going to show you the delivery notices, the Shanghai arbitrage, and exactly how to survive the $50 billion tsunami without getting shaken out. The number 60 isn't just a digit on a spreadsheet. It is the tripwire for a financial explosion that has been decades in the making. To understand why your world is about to change, you have to understand the math of the gold-silver ratio, the most important relationship in the history of money. For years, we've watched this ratio hover at 80-1 or even 100-1, telling us that the world viewed silver as nothing more than a discarded industrial metal, a byproduct of lead and zinc mining that had lost its monetary soul. But today, the ratio didn't just move, it detonated. When that number slipped below 60, it crossed the Rubicon of the precious metals market. In the world of high finance algorithms and institutional risk management, 60 is the psychological and mathematical point of no return. It is the level where silver stops behaving like a commodity and starts behaving like a predator. Think of the ratio like a rubber band that has been stretched to the point of snapping. For every 1 ounce of gold, the market was saying it took 80 or 90 ounces of silver to equal its value. That stretch was artificial, held in place by massive naked short positions and paper manipulation on the COMEX. But when the ratio breaks 60, the rubber band does not just go limp. It snaps back with enough force to shatter the entire pricing mechanism of the New York and London exchanges. This is the detonation zone. It is the moment where the smart money, the sovereign wealth funds, and the massive pension endowments realize that silver is critically, historically mispriced relative to its yellow brother. Gold has already paved the road. It's trading at all-time highs, acting as the ultimate sanctuary against a failing dollar. But silver is the slingshot. And the moment the ratio breaks 60, the trigger is pulled. We have seen this movie before, and every time it plays out, the ending is the same. A vertical violent transfer of wealth that leaves the uninformed in the dust. Look back at 1980. The ratio spent years grinding away. But once it broke through that critical support level, silver didn't just catch up to gold, it went on a rampage. While gold had a respectable rally, silver outperformed it by a staggering 500% in a matter of months. It was a speculative fever that forced the exchanges to change the rules just to keep the system from collapsing. Then, look at 2011. We saw the exact same pattern. As the ratio compressed toward the 30s, silver moved from $10 to $50 almost overnight. It took the stairs up for years. But the moment that ratio logic took hold of the market's collective consciousness, It took the elevator to the penthouse. Those who were waiting for a pullback or a better entry were left standing on the sidewalk as the price gapped up $2 and $3 a day. What makes today different, and frankly more terrifying for the banks, is the sheer volume of capital waiting behind the 60 ratio gate. In 1980 and 2011, the move was driven by retail stackers and a few aggressive billionaires like the Hunt brothers. Today, the buyers aren't people, they are machines. We're talking about trillion-dollar pension funds that operate on strict hard asset allocation models. These models are hard-coded with a 60 ratio trigger. To an institutional algorithm, a ratio above 60 means silver is cheap, gold is expensive. But once it breaks below 60, the mandate switches from evaluate to execute. It sends a signal to the asset allocators that a regime shift is underway. It tells them that the decade of silver suppression is over and that the palm monetary premium is returning to the white metal. Imagine a pension fund manager in Norway or a university endowment in the Ivy League. They have a mandate to protect their capital against the 20% real inflation we are seeing in the economy. They look at gold and see it's already moved. They look at silver and see the ratio is 57. The math is undeniable. To gain the same level of protection, they would have to spend billions more in the gold market than they would in silver. It creates a massive, irresistible arbitrage opportunity. They begin to rotate out of their overvalued gold positions and slam that capital into silver. But here is the catch that the mainstream media will never tell you. The gold market is a vast ocean, while the silver market is a tiny, shallow pond. When you try to move ocean-sized capital into a pond-sized market, the water level doesn't just rise, it creates a tidal wave that sweeps everything away. This is why 60 is the danger zone. It is where the physical reality of supply meets the theoretical world of paper derivatives. The bullion banks, the JP Morgans and the HSBCs of the world have sold billions of ounces of silver that they do not possess. They have used the paper ratio to keep the price down. But an algorithm at a pension fund doesn't care about their short position. It only cares about the ratio. When the algorithm hits buy, it demands delivery. It wants the bars in the vault. And as that $50 billion wave of institutional rotation begins to move, it is going to hit a COMEX vault that is already seeing registered silver levels at multi-decade lows. We are talking about a liquidity vacuum. If you are sitting there thinking you have time, you are ignoring the ghost of 1980. You are ignoring the fact that once the 60 ratio breaks, the front running begins. The traders in Shanghai and London aren't waiting for the pension funds to buy on Monday. They are buying now because they know the pension funds must buy on Monday. It's a self-fulfilling prophecy of exploding prices. The ratio is the heartbeat, and right now, that heart is racing. We are witnessing the death of the cheap silver era. When the history books are written about the great revaluation of the 2020s, they will point to this specific week, the week the ratio broke 60, as the moment the paper system finally snapped. The banks are currently trapped in a deliver or die ultimatum. They can try to smash the price with more paper, but doing so only makes the ratio even more attractive to the algorithms, drawing in even more institutional sharks. They are pouring gasoline on a fire, thinking it will put it out. This 60 ratio detonation is the bat signal for every whale on the planet. They know that silver is the only asset left that hasn't hit its inflation-adjusted all-time high. Gold has done it, Bitcoin has done it, the S&P 500 has done it. Silver is the last man standing, and the 60 ratio is the starting gun for its sprint to $100 and beyond. If you are watching the price on your screen flicker, realize you aren't looking at a market. You are looking at a countdown clock. And that clock just hit 0. The $50 billion wave isn't coming. It's already here, and it is fueled by the most powerful force in finance: mathematical inevitability. The ratio has spoken, and the era of silver's dominance has officially begun. I've spent years warning you about the short circuit. I've spent years telling you that the paper-to-physical disconnect would eventually lead to a limit-up scenario, where you simply cannot find a bar of silver for any price. The breaking of the 60 ratio is the final confirmation that we have reached that event horizon. This is the moment where the stacker becomes the wealth holder. While the rest of the world is chasing the latest tech bubble or crying over their failing bond portfolios, the silver holder is standing on the right side of the most significant ratio shift in 40 years. The fuse is lit, the ratio has detonated, and next week, the world wakes up to a new reality where silver is no longer an industrial byproduct, but the king of the board. The math of the $50 billion mandate is not a theory, and it isn't a gold bug fantasy. It is the cold, hard reality of institutional physics. To understand why next week will feel like a tectonic shift, you have to look at the sheer scale of the institutional ocean compared to the tiny silver pond we've been swimming in. For decades, the world's largest pools of capital, the pension funds that manage the retirements of teachers, firefighters, and civil servants, have been parked in the bond market. They'll have been chasing a safe 2% or 3% return in a world where inflation is eating 10% of their purchasing power every single year. But as the bond market begins to fracture and the currency loses its grip, these giants are being forced to look for a lifeboat. And their eyes have just landed on silver. When we talk about a 1% shift, it sounds small to the average retail investor. In your personal portfolio, 1% is a rounding error. But in the world of institutional finance, where the top 100 pension funds alone manage over $20 trillion, a 1% shift is a financial nuclear weapon. Right now, these funds are effectively zero weight in silver. They own nothing. Their models have been built on the assumption that paper assets would rule forever. But the Arctic Storm's trigger we just witnessed, the gold to silver ratio crashing below 60, has changed the logic of their rebalancing software. These funds operate on what we call inelastic mandates. They don't have a choice. When the model says rebalance to maintain parity, the buy orders are generated automatically. If only a handful of these mega funds decide to move just 1% of their failing bond allocations into silver to capture the ratio compression, we're looking at an immediate, non-negotiable demand of $50 billion. Now, let's look at the pond they're trying to dive into. The total amount of investment-grade silver produced globally every year is roughly 800 million to 1 billion ounces. At a price of $25 or even $30, the entire annual supply of silver is worth maybe $25 billion to $30 billion. Read that again. The entire year's production of the planet is worth less than what these pension funds are mandated to move in a single week. This is the definition of a supply-demand mismatch on a biblical scale. If $50 billion in institutional capital tries to enter a market that only produces $30 billion in a year, the price doesn't just go up, the price discovery mechanism breaks. You cannot fit an ocean into a thimble. To accommodate that $50 billion wave, the price of silver has to move to a level where the dollar value of the existing supply matches the incoming capital. That is how you get silver at $100, $200, or even higher. It's not about value anymore, it's about the physics of liquidity. The pension fund managers are currently staring at their dashboards in a state of controlled panic. They know that if they wait until Monday morning, they will be competing with every other fund on the planet. They are looking at the silver pond and realizing there is no depth. There is no registered inventory on the COMEX to satisfy their hunger. In fact, if you look at the current COMEX vault data, the amount of silver actually available for delivery, the silver that is not already spoken for, is a fraction of what it was 2 years ago. We are talking about maybe 30 or 40 million ounces of registered silver. At $80 an ounce, that entire vault is worth only $3.2 billion. Think about that math. A $50 billion institutional wave is heading toward a vault that only holds $3.2 billion in available physical metal. This is the short circuit. This is the moment where the paper-silver system, which trades 100 ounces of paper for every 1 ounce of physical, finally hits the wall of reality. The pension funds are price inelastic buyers. Unlike a retail trader who might see silver jump to $5 and decide to wait for a dip, a pension fund with a $5 billion buy order doesn't care about a $5 move. They have to fill the order. They have a fiduciary responsibility to move out of the danger zone of failing bonds and into the safety zone of hard assets. If they can't find the silver at $80, they will bid $85. If it's not there at $85, they will bid $95. They will keep bidding until they find a seller, but the problem is the smart money stackers aren't selling. The strong hands, who have been holding through the manipulation, are looking at this 50 billion wave, and they are tightening their grip. We are moving into a liquidity vacuum, where the ask price simply disappears. This shift from bonds to silver is the most significant macro rotation of our lifetime. For 40 years, bonds were the safe haven, but today, bonds are return-free risk. As interest rates fluctuate and the debt ceiling looms, the institutional managers are realizing that the only way to meet their future pension obligations is to own the one asset that cannot be printed and cannot be defaulted on. Silver is the high beta version of gold. It's the turbocharged engine of the precious metals market. When the institutional ocean begins to leak into the silver pond, the water level, the price, has to rise vertically to prevent the pond from being completely sucked dry. What you are seeing on the screen right now, that $79 or $80 price, is the market trying to front-run the inevitable. The traders who are awake during this ghost week are desperately trying to accumulate every ounce of physical metal they can find, because they know they can flip it to the pension funds next week at a massive premium. They are the whales before the leviathans arrive. This $50 billion mandate is the guns of August for the silver market. It is the moment the war begins in earnest. The banks, who are sitting on massive short positions, are currently looking at their margin calls and realizing that no amount of paper smashing is going to stop a $50 billion institutional wave. You can't fight an algorithm with a press release. You can't fight a $20 trillion ocean with a paper umbrella. As we move toward the Monday open, the tension is reaching a breaking point. The mandate has been signed. The ratio has been triggered. The capital is incoming. We are about to witness the greatest squeeze to infinity in the history of the COMEX. This isn't just about making a profit. It's about surviving the collision between a $50 billion tsunami and a market that is effectively bone dry. The next 5 trading days will be the most violent, the most volatile, and the most profitable days we have ever seen, because the math no longer allows for any other outcome. The institutional ocean is coming for the silver pond, and if you aren't already in the boat, you're going to be swept away in the surge. The calendar in front of me isn't just a list of dates, it is a tactical map for a financial ambush. We have entered the most treacherous corridor in the history of the COMEX, the death zone, between the monthly options expiry and the first notice day for physical delivery. If you've ever wondered why the volatility feels different this time, why the price action is acting like a caged animal, it is because the big shorts, the bullion banks like JP Morgan and HSBC, have run out of time to manipulate the clock. In the paper markets, they can kick the can down the road indefinitely. They can roll over contracts. They can swap digits on a screen, and they can hide behind the opacity of the over-the-counter markets. But the calendar is the one thing they cannot manipulate. On Monday morning, the clock strikes midnight, and for the first time in a decade, the banks are facing a deliver or die ultimatum that they cannot print their way out of. We are currently sitting in the eye of the storm. The monthly options expiry just slammed shut, and for the first time, the Win-Max pain theory, the idea that banks always pin the price to the level where most retail options expire worthless, failed spectacularly. The price ripped right through their defenses. This tells us that the banks no longer have the dry powder to suppress the spot price. But the real danger, the reason I titled this Danger Next Week, is the delivery notice period starting Monday. This is the moment where the paper game stops and the physical game begins. When a trader holds a long contract into this period, they aren't looking for a cash settlement. They are demanding the bars. They are demanding that the silver be moved from the eligible category to the registered category and loaded onto a truck. And as we head into Monday, the delivery notices are piling up like a mountain of debt that the banks simply cannot service. You have to understand the sheer desperation inside the walls of these bullion banks right now. For years, they have operated on a fractional reserve system for silver. They have sold roughly 100 to 500 ounces of paper silver for every single ounce of physical metal sitting in their vaults. It's a giant game of musical chairs, and for years, they have been able to keep the music playing by shaking out the retail weak hands with sudden flash crashes. But next week, the music stops, and the people holding the contracts aren't retail traders anymore. They are the sovereign wealth funds and the $50 billion pension wave we just discussed. These aren't people who will be scared away by a $5 dip. These are entities that need the physical metal to collateralize their failing currency positions. They are going to stand for delivery. And when they do, the banks will have to find silver that doesn't exist. Monday is day 0. The banks are facing a liquidity black hole. If they can't find the physical bars to satisfy the delivery notices, they have 2 choices, and both of them lead to a vertical price explosion. Option 1, they enter the open market and try to buy the silver themselves. But remember, they are short millions of ounces. If they start buying, they trigger their own short squeeze, effectively lighting their own house on fire to keep from freezing. Option 2, they offer cash in lieu of delivery. They go to the contract holders and say, "We don't have the silver, but we'll pay you a 20% or 30% premium to walk away." But in a world where the gold to silver ratio has already broken 60 and the composite ghost wave is hitting the shore, why would any sane investor take a paper bribe when they know the physical metal is the only true wealth left? The moment the market hears that a bank is offering cash in lieu, it is a signal of default. It is the blood in the water that brings every shark on the planet to the COMEX. This is why the next 5 trading days are the Widowmaker zone. The banks are backed into a corner, and a cornered predator is at its most dangerous. Expect to see the most desperate slam attempts in history. You might wake up on Tuesday morning and see silver down 8 in 30 seconds on zero news. That isn't a market sell-off. That is a bank attempting to trigger stop-loss orders to grab your physical metal before they have to settle their own delivery notices. They are trying to shake the tree one last time to see if any silver falls out. If you are over-leveraged, if you're trading on margin, they will wipe you out. This is why you must hold physical or fully allocated positions. You cannot play their game on their turf when they are facing an existential threat. They are fighting for their lives while you are fighting for your future. The danger: next week's calendar also coincides with the reopening of the London and Shanghai markets after the holiday lulls. We are seeing a massive arbitrage gap, where silver is trading significantly higher in the east than it is in the west. This means that any silver that is available is being sucked out of New York and London and shipped to China. The banks are watching their vaults drain in real time while their delivery obligations are expanding. It is a mathematical pincer move. By Wednesday, the delivery ultimatum reaches a fever pitch. If the banks haven't covered their shorts by then, the exchange might be forced into a force majeure, or a trading for liquidation only event. We have seen this happen in nickel. We have seen it happen in palladium. Silver is the big one. Silver is the Achilles heel of the entire central banking system. As we march toward the Monday Open, I want you to visualize the COMEX vault as a fortress under siege. Outside the walls, you have $50 billion in institutional capital demanding entry. Inside the walls, you have banks that have sold the same bar of silver to 10 different people. The delivery notice is the knock on the door that they cannot ignore. The calendar has stripped away their ability to hide. This is the ticking clock narrative in its purest form. Every hour that passes brings us closer to the moment the paper mask is ripped off and the true physical price of silver is revealed to a shocked world. Don't let the strobe light volatility blind you. The banks want you to panic. They want you to look at the flickering price on your screen and forget about the ratio, forget about the pension funds, and forget about the empty vaults. They need your ounces to survive the week. But if you understand the calendar, if you see the deliver or die ultimatum for what it is, you realize that the danger isn't for us. It's for them. We are the ones holding the collateral in a world that is suddenly desperately short of it. The next 120 hours will redefine the financial landscape. We are moving from a price discovery phase into a physical grab phase. The calendar is set, the notices are filed, and the big shorts are out of time. Monday morning, the trap snaps shut. While the paper traders in New York are staring at flickering digits on a screen, there's a much louder, much heavier reality unfolding on the loading docks of the world's major bullion vaults. We have officially entered the era of the physical disconnect. A period where the price you see on CNBC has as much to do with the reality of silver as a toy car has to do with a Formula One engine. The paper price is a ghost, a remnant of a dying system, but the physical reality is measured in the sound of heavy-duty tires and the hiss of air brakes. For the past 72 hours, my sources near the major depository hubs have reported an unprecedented surge in armored transport activity. We aren't talking about a few bars being moved for a retail order. We are talking about a systematic, desperate drain. Truckloads of silver are leaving the vaults in the dead of night headed for private destinations and overseas refineries, and the data I am seeing suggests that the registered category, the silver actually available for trade, is being gutted in real time. If you want to know the truth, you have to ignore the ticker and look at the premiums. In a healthy market, the price you see on your phone is the price you pay at the shop, plus a small fee for the dealer's overhead. But look around you right now. While the COMEX spot price might be sitting at $79 or $80, try actually buying a 1-ounce Silver Eagle or a 100-ounce bar. You'll find that the real price, the price required to actually get metal into your physical possession, is already $15, $20, or even $25 higher than the official quote. This is the truth gap. It is the clearest signal that the paper market has lost all control over the physical world. The market is telling you that the paper contract is a lie. It's a promise that the banks know they cannot keep. If you want the metal, you have to pay the physical reality tax, because the people who actually hold the silver know exactly what it's worth in a world of 50 billion pension mandates. The drain of the registered vaults is the smoking gun of this crisis. For those who don't follow the plumbing of the COMEX, registered silver is the only silver that can be used to settle a futures contract. Eligible? Silver is simply silver sitting in the vault that belongs to someone else. It is not for sale. For years, the banks have played a shell game, moving silver back and forth between these categories to make the vaults look fuller than they are. But you can only play that game for so long before the music stops. We are now seeing registered stocks hit levels that haven't been seen since the 1990s, even as global demand has quadrupled. The physical pivot has begun. When a $1 trillion pension fund decides it needs silver, it doesn't want a warehouse receipt. It wants the bars under its own jurisdictional control. It wants the security of the vault door. And as those trucks pull out of the COMEX depositories, they are taking the last of the cheap silver with them. I want you to think about the logistics of moving $50 billion worth of physical silver. This isn't Bitcoin. You can't move it with a private key and a click of a button. Silver is heavy, it's bulky, and it requires massive security. The fact that we are seeing this level of movement during a ghost week tells you that the buyers are in a state of absolute urgency. They aren't waiting for a better entry. They are paying whatever it takes to secure the physical float before the danger week begins. This is why your local coin shop is likely out of stock or quoting lead times of 6 to 8 weeks. The retail market is the canary in the coal mine. It was the first to realize that the paper price was a fiction, and now the institutional giants are catching up. They are bypassing the exchanges entirely and going straight to the refiners, outbidding everyone else to ensure they aren't left holding a worthless paper contract when the system resets. The disconnect between the screen price and the shop price is the final warning for the retail investor. We are witnessing the birth of a two-tier market. In Tier 1, you have the paper market, where banks trade imaginary ounces back and forth to maintain the illusion of stability. In Tier 2, you have the real market, where physical silver is being hoarded by sovereign states and institutional whales. The gap between these two tiers is going to continue to widen until the paper market simply ceases to function. We saw this happen in the palladium market, where the spread became so large that the exchange effectively broke. Silver is on the same trajectory, but on a scale that is 100 times larger. When the real price is $20 higher than the paper price, it means the paper market is already in a state of hidden default. This is the mechanical glitch I mentioned earlier. The banks have used paper to suppress the price for so long that they created a massive artificial vacuum. Now that the ratio has broken 60 and the ghost wave has been triggered, the vacuum is sucking in every available ounce of physical metal on the planet. The truckloads of my leaving the vaults are the physical manifestation of a system that has run out of time. Every bar that leaves a COMEX vault and enters a private pension fund vault is a bar that will never, ever return to the paper market. It is gone to ground. This is the permanent removal of supply from a market that was already in a structural deficit. The bone dry vault isn't a prediction. It is an emerging reality that you can see if you just look at the shipping manifests and the delivery notices. Next week, when the adults return to their desks and see that the vaults have been drained of another 10 million ounces over the holiday break, the panic will go from controlled to absolute. They will realize that the paper silver they are holding is a claim on an empty room. This is the moment where the squeeze becomes a panic. If you are waiting for the spot price to tell you when to buy, you are looking at the wrong indicator. The spot price is the price of the illusion. The shop price, the price of the physical bar in your hand, is the only price that matters. And that price is currently screaming that we are at the end of the line. The physical disconnect is the final bridge to cross before silver goes vertical and leaves the paper system behind forever. In the sterile, fluorescent-lit offices of the world's largest asset managers, a terrifying realization has taken root. The US dollar is no longer a safe haven. It is a melting ice cube. For 40 years, the global financial system was built on the bedrock of the risk-free rate. But as we enter this danger week, the bedrock has turned into quicksand. This brings us to the core of the $50 billion wave, the transformation of silver from an industrial metal into the ultimate anti-dollar. While the general public still thinks of silver as something used in solar panels or jewelry, the institutional giants have reclassified it. They are looking at a failing bond market where guaranteed returns have been replaced by guaranteed losses in real terms, and they are desperately searching for a hedge that can outrun the printing press. This is why the wave is hitting silver first and hitting it hardest. To understand the anti-dollar context, you have to look at the carnage in the bond market. Pension funds are traditionally the largest holders of government debt, but when inflation is running at 10% and your bonds are only paying 4%, you're losing 6% of your wealth every single year just by standing still. It is a mathematical death spiral. The fund managers know they cannot meet their future payout obligations by holding onto depreciating paper. They need an asset that exists outside of the central bank S-ledger, an asset with no counterparty risk and a finite supply. Historically, they would have flocked exclusively to gold. But this time, the models are screaming something different. They are screaming silver, and the reason is a concept known in finance as high beta. Beta is simply a measure of an asset's sensitivity to the broader market. Gold is the steady captain. It moves predictably and preserves wealth. But silver is the slingshot. Because the silver market is so much smaller and more illiquid than gold, when the flight to safety begins, silver doesn't just follow gold, it explodes past it. The pension funds aren't just looking to preserve what they have. They are looking to recover the massive losses they've suffered in the bond market over the last 3 years. They are choosing silver because it offers the same anti-dollar protection as gold, but with a built-in growth multiplier. If gold goes up 20%, silver has the historical precedent to go up 60%, 80%, or even 100%. To a manager who is billions of dollars behind on their pension liabilities, that high beta potential isn't a luxury, it is a necessity. This is the psychological engine driving the great rotation, and the flight to safety is becoming a flight to performance. As the dollar index flickers and the world watches the debt to GDP ratios of Western nations soar into the stratosphere, the institutional algorithms are identifying silver as the single most undervalued hedge on the planet. They are looking at the currency hedge not as a defensive play, but as a proactive offensive strike. They are shorting the dollar by longing silver. Every ounce they take off the COMEX is a vote of no confidence in the fiat system. And because silver is so cheap relative to gold, even at 80, they can accumulate massive positions that will provide a wealth explosion. The moment the rest of the world realizes the dollar is in a permanent decline. Imagine the pressure inside an investment committee meeting for a multi-billion-dollar endowment. They see the ratio below 60 alert. They see the bond market cratering. They see the ghost wave forming. They realize that if they stay in the dollar, they are choosing a slow death. If they move to silver, they are choosing the ultimate hedge against the very system that is failing. Silver is the anti-dollar because it is everything the dollar is not. It cannot be created with a keystroke. It has intrinsic industrial value that provides a floor, and it has a 5,000-year track record as money. But more importantly, it is the only asset that hasn't been fully priced for the current level of currency debasement. If silver were to match the expansion of the U.S. money supply over the last decade, it wouldn't be at $80. It would be at $400. That is the beta the pension funds are chasing. The $50 billion wave is the physical manifestation of this loss of trust. When a pension fund moves 1% of its assets into silver, they are effectively saying, we no longer believe the government can repay its debts in a currency that has value. They are front-running the total re-rating of the global monetary system. And as they enter the market, they are creating a feedback loop. Their buying drives the price higher, which further breaks the gold to silver ratio, which triggers more algorithms to buy, which further exposes the dollar's weakness. It is a cascading event. The safety they are seeking in silver is becoming the very thing that accelerates the dollar's irrelevance. You have to realize that these giants are inelastic. They aren't looking to day trade silver for a quick buck. They are looking to hold it as a core Tier 1 collateral asset in a post-dollar world. This is why the current paper price is so irrelevant. The pension funds aren't buying the price. They are buying the ounces as a hedge against a systemic collapse. They see the dollar as a burning building and silver as the only fire exit left. The $50 billion wave is the sound of the stampede toward that exit. As the anti-dollar sentiment grows, the silver pond will be completely overwhelmed by the institutional ocean. This isn't just a market rally. It is the final divorce between hard assets and fiat currency. The high beta nature of silver means that the move we are about to see next week will be unlike anything in living memory. When the largest pools of capital on Earth decide that the safe haven is actually a trap, and the industrial metal is actually the new gold, the price discovery is going to be vertical. We are moving toward a new reality, where your wealth is measured not by how many dollars you have in a bank account, but by how many ounces you have in the vault. The $50 billion wave is just the beginning. It is the first wave of a tide that will eventually wash away the paper illusion and leave only the physical truth behind. Next week, the world learns that you can pay for the future with the ghost of a currency. You pay for it with the anti-dollar. And that anti-dollar is silver. While the West is distracted by the flickering ticker tapes of Wall Street, a massive silent vacuum has opened up in the East, and it is draining the lifeblood of the American silver market. To understand the global squeeze, you have to stop looking at silver as a local commodity and start seeing it as a fluid that always flows to the highest bidder. Right now, that bidder is China. We are witnessing a historic arbitrage gap between the Shanghai Gold Exchange, SGE, and the COMEX in New York, a price divergence so wide that it has effectively turned every bullion dealer and hedge fund in the world into a vacuum cleaner, sucking physical bars out of Western vaults and teleporting them to the East for an immediate risk-free profit. This isn't just a market quirk. It is a geopolitical siphon that is leaving U.S. pension funds and domestic investors high and dry just as the $50 billion mandate hits the fan. Look at the data coming out of the Shanghai night sessions. While the New York paper price struggles to maintain its footing, the physical price in Shanghai is trading at a premium of 10%, 15%, and sometimes as high as 20% over the Western spot price. For a professional arbitrageur, this is the holy grail. They can buy silver in London or New York at the suppressed paper price, take physical delivery, and immediately ship it to Shanghai to sell it for $10 or $15 per ounce profit. When you are moving millions of ounces, that isn't just a trade, it's a heist. This price gap is the mechanism by which the East is systematically destocking the West. Every single day that the COMEX remains lower than Shanghai, more silver leaves the Western Hemisphere, and once it crosses the Pacific, it never comes back. It enters the strong hands of the Chinese government and the massive retail base in Asia, where silver isn't seen as a speculative play, but as the foundation of the new digital yuan collateral. The reason this creates a danger zone for next week is simple. The US pension funds are entering a market that is already being hollowed out. They are showing up to a grocery store where the shelves have been cleared by a massive buyer who got there 2 hours early. As these $50 billion institutional mandates go live on Monday, the fund managers are going to realize that the liquidity they were promised by the bullion banks doesn't exist in the West anymore. It has already been shipped to the East. They are going to call their brokers at JP Morgan or HSBC and demand delivery, only to find that the vaults in New York are filled with nothing but dust and IOUs. This is the international pincer move. While the bullion banks were busy using paper shorts to keep the price down in New York, they forgot that the rest of the world actually values the metal. They've successfully kept the price low, but in doing so, they've made silver the greatest bargain in history for Chinese buyers, who are now more than happy to take the physical inventory off our hands. I want you to think about the desperation of a US-based fund manager who has been told to rebalance $500 million into silver. He looks at his screen and sees silver at $79. He calls his desk and says, "Buy it all." But the desk comes back and says, "There's no physical available in New York, but we can get it for you in Shanghai for $95. Suddenly, the official price becomes a total fantasy. The manager is forced to chase the price higher, competing not just against other US funds, but against the sovereign appetite of the Chinese dragon. This global squeeze is effectively a run on the Western banking system. The East has realized that the paper-to-physical ratio in the West is a fraud, and they are using their massive dollar reserves to buy the fraud and replace it with real, tangible silver. They are exchanging our fiat paper for our hard assets, and they are doing it at a discount that we've graciously provided them through our own market manipulation. This is why the delivery notice period next week is so critical. The banks are staring at a global arbitrage that they cannot close. If they raise the price in New York to match Shanghai, they trigger a short squeeze that bankrupts their own trading desks. If they keep the price low, the silver continues to bleed out to the East until there's nothing left to settle the domestic contracts. They are in a checkmate position. The smart money in London is already jumping ship. We've seen record-breaking outflows from the LBMA, London Bullion Market Association, vaults over the last few months. The silver isn't disappearing, it's just moving. It's moving to where it is respected. It is moving to where the ratio below 60 is seen as a signal to hoard, not a signal to trade. For you, the viewer, this means that the scarcity you have been told about is much worse than it appears on the surface. We aren't just dealing with a lack of production. We are dealing with a geographic exodus of the metal. If you are waiting for a dip in the New York price, you are essentially betting that the Chinese will stop wanting real wealth. They won't. In fact, the Shanghai premiums are acting as a magnet, pulling the world as a supply toward the East and forcing the Western price to eventually snap to the global reality. When that snap happens, it won't be a gradual move. It will be a limit-up event where the COMEX is forced to shut down because the price gap becomes unmanageable. The $50 billion wave of US capital is about to collide with a market that has been exported to Shanghai. The global squeeze is the final nail in the coffin of the paper-silver system. It proves that you cannot control a global commodity with a local printing press. As the sun rises in the East next week, the Shanghai traders will set the tone, and that tone will be one of aggressive, relentless accumulation. The arbitrage will remain open until the Western vaults are empty or the Western price explodes to parity. Given the speed of the ghost wave, I bet on the latter. We are entering a week where the price discovery will be dictated by the East, and the price recovery will be forced upon the West. The silver is leaving, the banks are trapped, and the global squeeze is about to turn the 50 billion wave into a global tsunami that redefines the value of every ounce you hold. As we stand on the precipice of this danger week, the time for theory has ended and the time for position has begun. You are no longer just a spectator watching a market ticker. You have been upgraded to an institutional frontrunner. By understanding the 60 ratio detonation, the $50 billion pension mandate, and the physical drain of the West, you are now operating with the same data set as the sovereign whales and the algorithmic predators. But having the data is only half the battle. The other half is surviving the Widowmaker volatility that is about to be unleashed. The banks know their system is failing, and as they prepare for the deliver or die ultimatum on Monday, they will use every psychological weapon in their arsenal to shake you out of your position. They want your silver because they need your silver. The coming days will be defined by volatility washouts. You must prepare yourself for price swings that look like heart monitors on a caffeine high. 1 hour, silver might be up $12 on news of a COMEX default. The next, it could be slammed down 8 in a flash crash, designed to trigger retail stop-loss orders. This is the institutional game. They hunt liquidity. They know that retail investors often place their sell orders at round numbers, or just below technical support levels. When they need to cover their own massive short positions, they engineer a sudden drop to harvest those retail ounces. To survive this, you must adopt the institutional mindset. You don't trade the flicker, you trade the thesis. If the gold to silver ratio is still below 60 and the pension funds are still moving 50 billion, then an $8 dip isn't a signal to sell. It is a gift. It is the last chance to accumulate before the trapdoor slams shut for good. Becoming a captain of capital means moving your wealth from the sector speculative bucket to the generational bucket. The people who lost everything in 1980 and 2011 weren't the ones who bought silver. They were the ones who bought silver on margin. They were the ones who used borrowed money, allowing the banks to liquidate them during a temporary price spike. Your survival blueprint is simple. No leverage, no margin. Physical metal in your possession or fully allocated in a secure vault. When you own the metal outright, time is your ally. The banks are the ones on a clock. You are the one who can wait. By removing the threat of a margin call, you strip the bullion banks of their only real power over you. You become a strong hand, an immovable object that the $50 billion wave must flow around. Look at the horizon. We are witnessing the final transfer of power from paper to physical. For decades, the captains of capital were the people who could print digits on a screen. But in the world of the 60 ratio detonation, the new captains are the ones who hold the physical collateral. As the dollar continues its slow-motion collapse and the bond market fractures, the global economy is being forced back to a hard asset standard. By positioning yourself now, before the pension fund stampede reaches its peak, you aren't just protecting your savings. You are front-running the greatest revaluation of the century. As the Sunday night markets open and the Shanghai-New York arbitrage gap begins to scream, remember why you are here. You aren't here for a 10% gain. You are here for the $100 silver reality. You are here because you realize that the silver pond cannot hold the institutional ocean. When the headlines start screaming about market instability and silver shortages next week, don't let the noise distract you. The danger is for those who are late. The danger is for the banks that are short. For you, the volatility is merely the sound of the old system breaking apart to make way for the new. The ghost wave is no longer a shadow. It is a wall of water. The 60 ratio is a smoking crater. The truckloads have left the docks. Everything we have discussed has led to this moment. You have the map, you have the math, and you have the physical metal. Now all that is left is the discipline to hold. Don't be the retail victim who sells at the first sign of a bank-engineered dip. Be the institutional frontrunner who recognizes that we are in the midst of a historic squeeze to infinity. The era of cheap silver is dead. The era of the new captains has begun. Welcome to the right side of history.